Hello, everyone. This is Brittany Button. I'm a long-term care insurance specialist for Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Nationwide. During this session, we're going to discuss the difference between long-term care and chronic illness riders within life insurance. We'll also have some additional updates on the current long-term care marketplace and regulatory updates. So I'm thrilled to have Alyssa De La Cruz from Nationwide joining us today. But before I turn it over to Alyssa, I just want to mention that if you have any questions throughout the presentation, you may type them into the chat box on your screen. We'll make sure to get those addressed at the end of our presentation. So without further delay, Alyssa, let's get started.
Thank you, Brittany. Thank you, everyone, for hopping on. So absolutely, just like Brittany mentioned, that's what we will be going over. If you're visual like me, I will definitely show you what's on the agenda there, exactly what Brittany was mentioning, current marketplaces, differences in which is our meat of our product here, our solutions here as long-term care writers, and then how do you compare them with chronic illness writers. I think that's going to be an important topic because I think sometimes they seem so similar, but it is going to be those differences that are going to make that experience a little bit different, and why we should be explaining that to our clients, and maybe what they're hoping for, or what your intention with that solution may look different based on those differences, and what those regulatory updates around this looks like, and then consumer protection features, because I think that's something that we don't always realize could also be extremely valuable on that experience for our clients, on specifically the LTC writers, and how there is a higher standard of that, and that does help that client and consumer at the end of the day with that experience with that policy, especially if something like they do have a cognitive concern and that causes that policy to lapse. Where do those consumer protection features make a difference on LTC writers? So with that being said, I want to kind of give you a landscape of what's going on in the marketplace. So typically, when we think long-term care, or when we think of where this marketplace has grown from and the addition of these hybrid products or an LTC rider, and understanding where traditional long-term care falls into place. There's obviously still a place for it, but it has had a shift. We're starting to see a huge shift from that traditional marketplace into that LTC rider. And I think there's a number of reasons why that could be. One big one is going to be the increases on premium. And that could be for a number of reasons, but just beyond not pricing the solution correctly, I want to go in a little bit in depth so you have a good idea, because I know if those things come up, you get those letters in the mail, or clients get them in the mail, and how do you best explain this? So essentially, 20 years of a declining interest rate was a big one. You have to understand these products were priced in a manner that they were making an assumption that 40 to 60% of those claim benefits were going to come from these interest-bearing investments. So when you have a declining interest rate environment, and that's where you were hoping to pay claims from, as a portion of it or a good chunk of it, that makes a difference. These products were also priced for probably about a 4% lapse, that people were going to get rid of these policies or let them lapse, and that's really closer to 1%. So that just adds on to the situation that they're dealing with. The lack of gender-based pricing in the early days when these products were designed. Women are nearly twice as likely to file a claim. They are 2/3 of claims. So that makes a big difference when you're thinking of why these products had the increases that they were seeing, and why you've seen a shift in maybe there really aren't those single pay options, or the shorter pay options aren't always there in many of those solutions. You might be seeing those pay to 100s. So that does allow for that possibility that protection, that premiums could go up, even though these new policies are priced better with the lessons that they have learned from 20, 30 years ago when these things were impacting it, and hopefully those lessons were learned, but they're still not offering guarantees. So I think that's really where you've seen that shift happen. You can see in 2000, it made up about 750,000 policies of traditional. 2020 was 49,000. And there has been, as of 2022, my last updated number on that, there was a 23% drop from that number. So I think with all of those things combined, that's why you're seeing a shift in this marketplace to those LTC riders, because it has addressed better some of those concerns. One being that these products have been around for a long time, but they weren't really marketed very well. But what they do and why we're seeing that shift is it transitions really that goal from a life insurance policy to meet multiple goals. So somebody, that initial goal was life insurance. Now they can go ahead and shift during that stage and say, hey, I still have my policy. Clearly, I'm still alive. My next concern and risk is I need long-term care. So I think those are things that make those products and the solution more favorable, or why someone might be seeing that shift in that marketplace. They know their premium is protected from loss, so they're not dealing, they have the options for guarantees, but they also know that if I don't use this policy, I still have a death benefit. You have multiple premium schedules, so if you really wanted to do a single pay, shorter pays, you could lock that all in, so you don't have those concerns. And obviously that guarantee is going to be that big component to ease a lot of people's minds, especially if they came from a space of one, as advisors, seeing that and saying, I didn't really like having to explain premium hikes to my clients, or to clients that had dealt with those policies with their own loved ones and feeling like that was not the route they wanted to go for their own protection. So when we are looking at life insurance solutions with long-term care and chronic illness riders, we want to understand the differences, because it does make a difference on how they're classified. It will make a difference on how they can be marketed, the requirements for selling those solutions, how they're charged for, and whether or not they're underwritten. Kind of dive into, so we have a good grasp of what those differences are and help us put our clients in the right solutions and really address those differences if you're not aware of all of them. So usually there's a lot of confusion around the terminology. So chronic illness, we will see that in both of, or all these solutions, whether it's traditional long-term care, LTC riders, down to chronic illness riders. It is a state of your health that is required for claim. So that definition for chronic illness, according to 7702B, is that essentially you have a U.S. licensed healthcare practitioner. They must certify that you have one of these two things going on, and it is going to be the same for all of these. So the definition is still the same. It's, do I have a severe cognitive impairment? So that includes Alzheimer's and dementia, or I can't do 2 of my 6 ADLs for at least 90 days. So my bathing, my dressing, continence, eating, toileting, and transferring. So the definition is true for everything we're listing here. But the difference is going to be that LTC riders always pay for both temporary and permanent claims. So when we're thinking temporary, I want you to think of things that you can recover from. It still has to last 90 days. That is still true. But temporary could be, I've had a stroke, I've been in a vehicle accident, maybe I fell and broke a bone, and it's really unsure. The recovery period might be 3 to 6 months before I can really function the way I used to be able to. So those are temporary needs. Now, chronic illness riders they have the ability to limit their policies. And that, again, that's going to be us reading the fine print and understanding if that chronic illness rider does that. It may limit it to permanent claims, that this is going to be a permanent condition that I'm going to have for the rest of my life. It's a chronic permanent condition. And that could be a differentiator for somebody that can make a difference. So we talked about some of the updates we may see regulatory. So I want to kind of also define that too, because this will impact policies of the past and also policies created today. So when we think of the old Interstate Compact, how it was written, and this includes most states, not all states, but in general sense, it was that definition for chronic illness was that, yes, you're likely to be certified that you're going to need care for the rest of your life. So that's the old regulation. New regulation as of 2014 does give the option that you could offer temporary claims. So you have the option to say it could be permanent need, it could be temporary need. It is an option, it is not a requirement. So that's why it's really important for us to know what that chronic illness rider is and what it does or does not do, what is in that contract. And it does not mean that the new rules grandfathered old policies of the past. So those are things you want to keep in mind. Now, whereas long-term care riders, that qualifying trigger still needs to last 90 days or more, but it's still, you can include temporary. That is required for LTC riders. So that is going to be a differentiator. You never have to worry about that temporary need. Now I want to focus a moment on tax qualified status, and there's a lot in here, but really what I want to focus on is just kind of the difference when it comes to what is required in an LTC rider. So it can be marketed. That's going to be a big difference. If somebody's marketing it as a long-term care rider, that's the only way you can do that. You cannot market a chronic illness rider as an LTC solution. That is not what it is. Only LTC riders can be marketed that way. So that's one thing. There is also the component that you are going to need. Majority states require you to have like a health license, and that you may have CE requirements. So your life, there's that LTC 8-hour initial training that's pretty common, and then every 24 months, an additional 4 hours that you have to add. So that is usually a requirement you see in most states, or at the bare minimum, life and health is a pretty common one as well. The riders are underwritten and they are charged for, but that is upfront. And you're going to usually see a dollar for dollar reduction of your benefits. So that's what you're going to see there. You know what your LTC benefits are determined, it's at issue. You know exactly what you're getting in the event of a long-term care event that is defined for you. And it will pay 100% of that amount, no matter when that claim does happen. So you're not dealing with a reduction of benefits, assuming you don't have loans or withdrawals. So that's going to be one component of it. Let me see if here we go. I thought it was going to skip to the other one. Let me differentiate something before I go into the chronic illness riders. So what are some differentiators within those models? It's going to be that payment mode. So these are probably typical ones you see. Probably the most common are going to be on each side of here, on the left and right. So reimbursement versus cash. So reimbursement is really only LTC costs, actual LTC costs that can be reimbursed. You're collecting receipts and bills. You may be able to do direct billing, but not all providers are willing to bill in those situations. So those are things you got to keep in mind. There might be some limitations on what those benefits will pay for and what might be out of pocket. Licensed providers are generally required. Indemnity and cash indemnity are very similar, where you might see some differences, but I think in today's terms, you're probably going to just really run into cash indemnity. It is a cash benefit, but there might be some proof that you'll have to make of billed services. There might be the requirement of some form of a licensed provider within there. So that's kind of the difference of indemnity. I don't see too many of those today. You really see cash indemnity, such as our solutions at Nationwide. Your full benefit is available for you. You can use it informally. Formal care, there's no receipts, there's no bills. There might be that you might have to show that there is care being provided initially at claim, but afterwards, that's usually not of concern. And then 100 of your benefits can be used for unlicensed caregivers or caregivers that family caregivers or licensed caregivers, and there's no restrictions on how you can use your benefits. So those are the models you're going to really find within the LTC rider, just so you're aware of that, what differentiates it, because they can be different with what's out there today. Now, when we're looking at tax qualified status of chronic illness riders, so we kind of went over some of those differences that you're going to see and how they're defined for what is required for an LTC rider, such as, trainings that you'll have to do, how they're calculated, the benefits that they have to promise, which is making sure that you know exactly what you get day one. So there's a requirements that an LTC rider has to do. These are how the chronic illness riders have to be defined in many of those cases. So they cannot be marketed as long-term care. They have to be marketed as chronic illness riders. Now, where that caveat was, it could cover temporary claims. It may not, where the LTC rider has to do that. It has to cover both for it to be an LTC rider. Now, even though the interstate allows it, does not mean it. It's just optional. So that, again, those are things we have to read and know. Does that cover that? Does not mean anything's grandfathered in. There is no CE requirements to sell or solicit those options. So that could also be some of the popularity of having that option, is that you don't have to add additional licenses or CE to do that. So there isn't. And then another component to it is how the benefits kind of pay out. Because again, you don't have to show what those LTC benefits will look like. They could be in a couple different formats. So we'll go over those formats just so you have an idea of why we want to be able to understand that and how that could vary per policy and how we explain that to our clients. So there's a dollar for dollar reduction method. So it's pretty common for what you'll see in LTC riders. There's a discounted method, and then there's a lien with interest method. So I'll show you all three in just a moment, how they will play out so that you can feel comfortable explaining it, or what, when you do see that within a policy, what does that mean for your client? So what differentiates a chronic illness rider? So in some cases, these are going to be, there could be a charge for a rider. So generally, your underwriting, or what, when we're thinking, the difference is some can have a charge. There might be underwriting. There's monthly deduction. So those are things to keep in mind. When they include it into the policy, sometimes you might hear, hey, sometimes I hear it's free of charge, or it's complimentary. There's just different ways you might have it. It's included, but generally what you're going to see is there's no underwriting for it. It's not free. It is charged at the time of claim. So those are things to keep in mind. Benefits are discounted at claim or at death by actuary factors. No charge if it's never used. So that's really the advantage you may hear of those products. That rider specifically is, well, if you never needed it, you were never charged for it. But also on top of that, you can't really determine what those benefits will look like until you get to that point of claim or death, because they're being calculated at that given point. So not knowing exactly what you might have for LTC at that time of event is something important to kind of stress, even though you have the advantage of, hey, there was no charge, I wasn't underwritten for it, if I never used it. But at that time, that's not what the client's going to remember. They're going to think, I did have something for long-term care and I didn't realize that it was going to be heavily discounted, or that I thought I may have had my whole benefit towards it. So that's what we're going to kind of go into and dive into, kind of how each of those work. Now, this is going to be true for the LTC rider and a few chronic illness riders. So this is the dollar for dollar method. And it's going to be a pretty self-explanatory one. It's a dollar for dollar reduction of your benefits. So you're going to see here, generally, you might see that there is a percentage given each month. Sometimes you can do, generally, you'll see 2% is the most common one, but you might see a 3%, you might see a 4% acceleration that you can get for your LTC benefits. This is generally a fully underwritten option, but let's look at this example here. We're assuming a 2% is the most common. It's a 50-month benefit, so that's how long it would take you to exhaust this. So this client has $400,000 of death benefit and LTC dollars. They're going to get $8,000 a month, because that's 2% of that $400,000. Annually, that's going to be $96,000. So that first year, this client goes on claim, and hopefully you're seeing that here on that screen. After that full year, what do they have left? It was a dollar for dollar reduction. They used $96,000. They have $304,000 left as death benefit or LTC. So you can see what's going on here each year that they go until we've exhausted 50 months. So you can see the following year, I'm down to $208,000 and so forth. And if I'm still on claim until I exhaust it, I can use it. It's a dollar for dollar reduction. If whatever I didn't use can go as death benefit. So that's a pretty common one. Also assuming chronic illness riders, those kind of things, if what has there, That's a pretty good one that generally a lot of individuals like to see, but that's not always what's out there. This is how an LTC rider does pay out, but let's take a look at how chronic illness riders could also have 2 other options that you want to look for to see how that works. So let's look at a discount method. So generally you're not seeing underwriting here. It's included with the policy. There is no charge, but it does not mean it's free. The death benefit is discounted at the time that you have this claim and you're going to start accelerating your benefits. Here are your variable factors. So it's not going to look the same for each client. How old they are when that claim happens, the gender. Women generally have it a little, they're going to get that discount even stronger than a male because they're likely to need it and need it for longer. Their risk class, the cash value. So those are things you want to keep in mind. Now, the acceleration of that death benefit that is not paid for chronic illness benefit is forfeited. So those are things to keep in mind as well. So let's take a look here. It's not like you pass away and you get that back as a death benefit. It's forfeited at that given point once you say, hey, this is the route I'm going. I need to accelerate this for LTC or for my long-term care needs on my chronic illness rider. So let's say this particular client is 70 and we'll look at male and female. So same situation, you could have a couple here going on claim. I have a $100,000 death benefit. If I am a male, now that's reduced to $65,000. So I'm forfeiting $34,000. If I'm a female in that situation, it's dropped to $56,000. I forfeited $43,000 because I have a no charge chronic illness rider. Obviously, it's a little bit better the older I am. So if I'm 85 as a male, 84,000 of that can go towards chronic illness benefits. If I'm female, 79,000. So those are things to consider. And sometimes that's where someone might say, I don't really like that. I didn't realize by not having a no charge that I lose so much of my benefits just to utilize this rider. The other option is a lien method with interest. Again, there's no underwriting. Generally, it is a lump sum benefit. It's usually the lesser of 50% of your benefit, death benefit, or 250,000. You can be subject to tax if it exceeds the IRS formula. So those are things that will be charged as ordinary income. The interest is charged on the acceleration. So we're going to look at an example here and say, okay, my policy is $500,000. My percentage elected or what was on my policy was 50%. So I can accelerate for my chronic illness $250,000. It's paid as a lump sum to me. And the rate for payments is 5.5%. The longer I'm on this claim and don't pass away, you can kind of see where that death benefit starts to continue to what my final death benefit decreases to. So there could be a point that I have nothing left of that remaining 250,000 I haven't touched of death benefit. So, you know, in this case, 13 years into it, for some reason, if I'm still haven't passed away, I've lost that death benefit that was left, that other 250,000. So you can kind of see where that difference, where that lien with interest starts really taking down your benefit. So that's why it's a really important conversation to have and to look at what that policy is doing, because it will make a difference on the policy that they paid for and what that experience might look like. And that might be something that maybe they lean one way or another, or if they're going to go with a chronic illness rider, I might looking for one that might be a dollar for dollar reduction. Or if I am looking at this one, is it maybe the most affordable option because it has a lien method or it has a discount method. So those are things to consider. Okay, so when we're looking at tax rule, this is common for all LTC benefits. So generally you have, IRS has guidelines so that you have tax-free long-term care benefits as long as there's the greater of the two. So you have a HIPAA per diem limit that the IRS sets and says, hey, this year it is $12,400 that we expect you to spend on long-term care. Anything under that amount, we assume that's what it's going to cost for long-term care or the actual qualifying expenses incurred. So that's So if you actually have receipts, so I'm thinking for some client that might be in New York, something like that, $12,000 a month is probably very low. They're probably, maybe they're spending $15,000, maybe they're spending $20,000 a month, depending on the kind of facilities that they're looking at. It just kind of all varies, but it's going to be the two. So either if you have a benefit that's below the HIPAA one, that's fine. It's either in that sense, the greater of the two. Now, if you get anything beyond that, it's taxed as ordinary income. That's important when we're coming up with that lump sum, when we're kind of looking at that lien method. That's where they're talking about that you might be subject to taxes if it exceeds that amount. So those are things you want to keep in mind, and the policy owner is who's responsible for paying those taxes. Now I want to spend a minute going over some consumer protections because I think this is an important one to keep in mind, and a higher standard that you might find on an LTC rider for your clients. So let's just learn a couple of things, and I'm sure this isn't new for a lot of us, but it's important when we go into why these consumer protections were created. So cognitive impairment is the #1 cause of LTC claims for someone 65 and older. Deaths from Alzheimer's have increased 145% since 2000, and 1 in 3 senior dies with Alzheimer's or another form of dementia. So these were critical and important as to why certain consumer protections were designed for LTC riders. And why that is to think and to keep in mind is because chances are when your clients are paying policies and they're paying them, maybe they're doing a pay to 100, they're paying 20 years, maybe a potential event could happen. LTC specific ones are required for all LTC riders. They are not required for chronic illness riders. They could have them, but they're not required. What are some of those consumer protection features that are required for LTC riders is lapse protection while they're on claim, reinstatement provisions with no underwriting, and extension of benefits provisions. So we'll go over them just briefly, just so you kind of have an idea of what those mean to somebody. So lapse protection. So essentially what you're looking for here is that this policy is, these benefits are still going to continue to pay even if the client hasn't paid premium. That is already built in. They're on claim. They're getting some kind of care. Usually some policies will say it has to be facility care, but they can also say any kind of care. So it can include informal care, but generally it does say facility care, but that's an also important thing to know. If your policy does say it has to be facility care, if you have a cash indemnity product, you want to know if that does also include informal care. So it's basically saying, hey, I needed long-term care, or maybe I already went on long-term care. My policy, I stopped paying that premium. Knowing that you have a lapse protection built into that is going to be an important feature. Chronic illness riders are not required to have that. Some do include it, so that's good to know. And then there might be, in some of those cases, they may require premium to be paid to avoid that benefit from lapsing. So you want to keep that in mind. Reinstatement provision. So LTC riders, you have to generally show a good reason why you couldn't pay premium for some reason to keep it in force, but it does not mean that you needed to meet full LTC claim standards. So it could be that maybe I'm starting to show signs of forgetting things. So if you can show a good reason, they can reinstate your policy. It leaves that door open for a good amount of time to reinstate your policies, generally for like 5 months, that they can give you that time. So that hopefully helps loved ones, if they're starting to see signs, give them the ability to say, hey, I'm realizing mom or dad's forgetting something. Then they forgot to pay these policies. Hopefully in that 5 months, it gives them time to get that policy reinstated. You don't have to show evidence of insurability. So that's important, because at that point, maybe you aren't paying premium because you already need long-term care. So you don't want to have that concern of, no, you have to show that you can still be insurable for this product. And the LTC riders tie the base policy to this the same with a more liberal standard. Now, when we're thinking of chronic illness riders, they're only required to offer the standards that are required in their base policy, which it may not be as liberal in that sense of how they can reinstate it. So that's basically like the life insurance policy. What would qualify you to be able to reinstate it there? They could require new evidence of insurability to reinstate that policy. If you cannot show that you are insurable at that point, it could mean that that illness rider still remains lapsed. The base policy may remain lapsed with a cognitive impairment. So those are things that could be important. Who wants their policy to lapse when you might be already showing signs that you need this policy, but now you're not insurable anymore, so now this policy lapsed. So those are things to keep in mind. Now your extension of benefits provision, same thing. You're showing pretty much the same thing is going on here, but on the chronic illness, it could mean that your death benefit isn't going to be paid as well because it's not a requirement. They don't have to include that. So understanding what happens in a reinstatement situation for our clients in those policies is going to be important. Understanding and reading that context to say, okay, if you miss a payment, what's going to happen? How are they going to help you reinstate it? Or are they going to help you reinstate it? Do I have to show insurability to reinstate my chronic illness rider in that situation? And what is or isn't required on my LTC rider? Does it include anything that is outside of this space? But this is just pretty much general stuff here. Now, the last thing I wanted to leave you with is just kind of a summary of what we went over. I know it's a lot of information, but what I want to make sure that you have and feel comfortable with is understanding that there is a difference between the two, and it's going to be all those nuances. LTC riders are pretty much general. They all have the same kind of features and all of these important things when it comes to lapsing, how they pay benefits, what they're required to be doing. Your chronic illnesses have a lot of differentiators. It can, the sense of how they pay out, how they are calculated, down to how they will reinstate the policy. Those are things you want to understand, even though it's included in the policy and it doesn't require underwriting in many cases. It could end up costing that client a lot of their benefits in that situation. So we want to think about what triggering conditions are covered because it may or may not be temporary. So temporary could last 6 months, it could be a year, and that could still be absolutely devastating to a family to cover those costs in those situations. So that might be important. Do I want to know if it covers temporary needs as well as permanent needs when it comes to chronic illness riders? If temporary claims are not included, that's one you're thinking of. How are those rider benefits calculated? How are rider benefits paid to the policy owner? If they're protected from the lapse, the reinstatement that we talked about, and are there provisions contained in that rider to pay LTC benefits even if the policy was unintentionally lapsed? So those are things we want to be asking and looking for when we are looking at chronic illness riders, because that can make that difference for that client, or at the very least so that they understand if that's the route they want to go, that they understand those things and say, hey, you're not getting this full benefit towards LTC. You might not possibly, we'll look at it and see, is it a lien method? Is it a dollar for dollar reduction? Is it a discounted method, so that they fully understand that if they want to go that route? Or it might be an opportunity for us to revisit those policies and say, hey, it's great to have that as an option, but maybe we want to add on top of that something that is protected and gives you that LTC rider features where you're getting those guarantees. It is a dollar for dollar reduction. You are protected from unintentionally lapsing the policy if you forgot to pay the policy because you're already going into maybe potential cognitive situations or ADLs. Maybe you had a hospital visit and dealing with that, you forgot to pay some bills and the policy lapse. Those are all important discussions to be had. With that being said, I'm going to go ahead and see if we had anything in the chat. I'm not sure if I can see it, but I'll double check there. But if not, I will see if Brittany, did you get any questions, or did you have any questions you wanted to address with the group?
Yes, so we did have a couple of questions come in on my end. First, this came over a couple of times. Yes, this session has been recorded. Simply by joining us for today's presentation, within about an hour after we leave today's session, you're going to receive an email from GoToWebinar thanking you for joining us, and that email will have a link for the replay. So keep an eye out for that, because I know we went over a lot of information. I know I learn something new every time I listen to Alyssa talk about this, so you're definitely going to be able to refer back to it. Lastly, we had a couple of folks ask about the long-term care CE certification.
Mhm.
Now, this varies in every state. Some states, as I call it, play well with others and will share that CE certification and allow for non-resident advisors to use that. Some get picky. California, you have to take their version of the long-term care CE partnership certification, and typically in most states, there's going to be an initial 8-hour CE course. Now, it's not going to take you 8 hours, but you do get 8 CE credit hours just by taking that. And depending on the state, there will be a refresher course required about every 2 years. Some states, it's every 24 months. Others go by licensing cycle. So if you have specific questions on your resident state, definitely call into the team and we can tell you more in detail. So, Alyssa, that kind of wraps it up really for today. So, thank you for presenting for us. Again, I learned something new every time you do this for us, so it is immensely appreciated. And everybody on the call, thank you. I know you take time out of your business hours to join us for these, and that too is also very much appreciated. So, our team is standing by if there are any further questions or you would like more information on Nationwide's portfolio. Can't tell you enough. It is a competitive option out there in the industry, not only on the long-term care insurance side, but the life insurance side as well. So we can be reached at 800-228-0008 or shoot us an email at ltci@jetter.com. So again, thank you everyone and enjoy the rest of your afternoon.
Thank you.